Hi there, welcome to Business Leadership Podcast. In this podcast, I interview successful business leaders and industry experts to help you grow your business. In this episode, my guest is Ron Harris from Financial Literacy Group. Ron's team not only provide tools and technical solutions to financial challenges, they also educate and spread awareness around the financial literacy challenges for all age groups. Ron Harris has over 20 years experience researching, developing, integrating sales and marketing solutions for startups and SMEs and corporations like a Union Bank of California, Prudential, KCBS, KCAL, KTLA, FatBurgers, Dahl Corporation, Sunkist, and he has research that now yield the country's most powerful personal banking tools. We had a very interesting discussion at the time where inflation is high and the mortgage cycles are getting longer and longer. It used to be 20, 30 years. Now people are talking about 30, 40 years for a mortgage, to pay off. And any other, loans are getting longer and longer as well. So he had a very unique perspective and a unique approach to how to pay off mortgages much faster. Whether it was a business loans or any personal loans, there was a way with his tools that you could be a debt-free much faster. So he also walked us through the tools as well. He showed us how he calculates all the numbers and how does he help out, and his company helps out the people to get the money back when they're trying to acquire any business or financial loan, and how they can pay much faster and build capitals. So hope you enjoyed this discussion. Don't forget to like and subscribe. Until next time, please welcome Ron Harris. I guess welcome to Business Leadership Podcast. Today my guest is Ron Harris. Ron, your area of expertise, financial literacy. This is ever needed topics. Everybody's going to use some help. So I'm looking forward to a discussion, looking forward to learning from you. Thank you so much for time and welcome to the podcast.
Thank you very much. I'm glad to be here.
Okay, well, so walk us through what is the financial literacy your company is about, and what do you guys do?
So financial literacy is, of course, a big topic. And so we definitely offer the solution, which is financial literacy. We actually offer an online course so people are able to take it at their own leisure. And we feel that it's really important for people to understand how money works and where they're going with it. But that's really just the beginning for us. We look at financials or financial literacy and financial wellness as a whole solution. Okay, so starting with the financial literacy, which means you need to learn how to make your money work for you, how to improve your cash flow, how to build wealth, and how to protect wealth, and all those kind of things are very important. But we also offer all of those kind of solutions as well. So what really makes us unique is the solution that we offer, and that solution is unique in a way that we are researched heavily in IRS codes, CARES Act 2020, which was really the catalyst for what we do. So what we offer is a technology that shows people how to pay off their mortgage, their debt, student loan debt or credit card debt, and getting rid of the interest. So the solution or the technology works in a way that shows people efficiently how to pay down their debt. So they can pay a 30-year mortgage and as little as 5 to 7 years, in fact. And then it's coupled with a banking solution or a life solution, which is an IUL. Mm-hmm. And it's integrated into the IUL, and the IUL works as an offset account. So in other words, the technology is giving the person step-by-step directions, telling them what to do, and they can move that money that the technology is telling them to move into an offset account. Start off with using HELOCs, as we started maybe 20 years ago. Then it moved into savings accounts, right, where people could use their savings or checking account and pay down their debt quickly. But now it's morphed into life insurance or an IUL. What the IUL is different about is in both the HELOC and the life insurance or the savings account, it allows them to pay the debt down quickly. But with the IUL, they're able to make money on that money that they used to pay off debt. So they're really turning their debt and their liabilities into income and wealth for their entire life.
So so it looks like this applied to not only businesses, apply to the personal account, mortgages, life insurance, all different financial areas that person need to interact with. It's not only targeted for one certain aspect of life. It's just it covers everything.
Covers everything, and really and truthfully, the life insurance that we use as a component or the offset account really comes from the business world. So it is a BOLI style policy or a bank-owned life insurance type of policy. And so we're giving an individual or middle class, working class, or homeowners the same life insurance policy that Bank of America would be using, right? So, and Bank of America has $24 billion of this kind of life insurance, in fact.
Got it.
Yeah.
Got it. Okay, so is that a piece of technology or is it a program? How does it work? How do people understand, like, how what's the process?
So I'm going to share my screen, but
Okay.
what it is it's a full solution, and it's, like I said, it's very much researched in the way that we offer this. So I'm going to, like I said, I'm going to share my screen,
Please.
and I'm going to bring up our main website and
Okay.
show you that. And so as you can see here, of course, there's a pop up there, but again, this is the main website, which is Financial Literacy Group website.
Okay.
And by the way, we do have a couple of websites, but the first one talks about what we do. And of course, this page on the top kind of refers to different things. So not only paying out debt, but banking like a bank. And then one of the things that's really important about what we do is in banking like a bank, is we feel that the banks really are in the perfect position, better than in any other type of company when it comes to money. They are able to make money on the rich because they participate in what the rich are doing and building capital and wealth, but they're also perfectly positioned to take advantage of the poor by charging them fees and interest rates and so on and so forth. So we kind of are an alternative to what's out there already, and we kind of really say that in our site. But as you can see here, we talk about financial wellness, what that means to a person. We actually do in different events. So we're going to be in Dallas on the 12th of October, but we talk about banking like a bank and what people get from that. We talk about the solutions that we offer, and those solutions, of course, are paying down mortgages. So we have a mortgage strategy. We have a tuition strategy, so we can help people plan for their future college, for their kids to go to college, starting at an early age. They can pay off the debt and then turn again their debt into income and wealth. Again, with all these different solutions that we offer, my team as well. But what's really important on this page is a couple of things. So first of all, I'm going to go here to this arbitrage page, and what this is really over the last couple of years, and most people, all over the country, they've been, really fooled by not only the personal finance gurus, but by the banks, listening to what the banks are telling them to do. And so what I did is we created this page here so that people could understand why it's different and why they should, use the kind of solutions that we offer, which are, again, paying off debt and then turning that debt into income and wealth. But if you listen to the banks or you listen to the gurus, and in many cases they are doing things differently in a way that they will tell people not to pay off a mortgage, right? Or not to buy a life insurance policy and a whole life policy. So first of all, I'm talking about a mortgage, they will look at a mortgage, and because, of course, especially the last couple of years when the interest rates were below 3%, they would tell people it's not feasible to pay off a mortgage because you have a low interest rate. You're never going to get cheaper loan to that. But that's not true when you really add amortization to the mortgage. So a person that has a 3% mortgage is really paying 51% interest on that home. So if they have a 6% mortgage, which is now kind of the standard because interest rates have changed, they're actually paying more money in interest than they are for the home itself, right? And so they're paying lots of interest, and that's what the profit for the banks is, the interest. So we're taking that interest and reducing it, sometimes as much as 75%. And so that person, by reducing that interest, is able to then build wealth. if you have interest that you pay to the bank, you're not really getting rich. You're paying money to the banks. That's what it is. And we have shown a different way of doing this than investing in mutual funds, or we're talking about 401ks. We're an alternative to those kind of things, right? And so what people do here is they first pay down their debt, and we show them how to do it. But we talk about the industry the way it is. So knowing that they've been fooled and they've been really brainwashed by the banks, and they've been brainwashed by advisors who really don't have, a stake in what that person makes. It's about themselves, really, truthfully. They're pushing products that normally make them money. And so rather
Mm-hmm.
than helping the client make money. So we talk about this on this page that you see here that is called arbitrage. We talk about the different fees, and we showed third party companies like Frontline or PBS talking about what it means to have fees, what a
Mm-hmm.
gamble it really is. We're talking about 60 Minutes and 401ks and how that works. And with most people, 401ks are really not making them enough money. They're subject to the ups and downs in the market. We're in an index or an IUL, index annuity, or an IUL. They're not subject to the ups and downs in the market. They have a floor, which is 0%. So they can never lose their principal when they're in a 401k or an IRA. So we really talk about those things, and we go through what people have heard. We talk about those different things, and again, from the point of view from a third party source, which is again PBS or 60 Minutes, and we talk about all those different things. Another thing that's really important to us is that people understand that what we're doing is researched. And so what you see here, this page is a white paper, and it's really about the IUL, but it's comparing a 401k, an IRA, and an IUL. And so most people are probably familiar with Chat GPT, which is
Mm-hmm.
an AI program. And what I did is we had Chat GPT go out and compare the three. First, talking about the changes in the IRS codes. And
Mm-hmm.
so what you see here is you see research that was done by ChatGPT talking about the difference in the three, or comparing the three. And some of these sentences that you see here are very benign, and most people don't think that they, look at them, they read them, they don't think they carry a lot of power, but they do. So for instance, on this one, I'm going to talk about this third topic right here. And as you can see here, ChatGPT is bringing that research, and it's talking about that IRS code 7702 defines what constitutes a life insurance contract for tax purposes. It
Mm-hmm.
sets the minimum death benefit that a policy must have to receive its cash value, or to qualify as a life insurance contract and receive tax advantages like tax-free death benefit or deferred cash value growth. Of course,
Mm-hmm.
401k, they have those things, but a 401k is what we considered a qualified account, which means it is pre-taxed. So you're going to pay taxes on that 401k when you take the money out. And of course,
Got it.
the 401ks are invested in things like mutual funds, and mutual funds carry fees, right? Where the products that we do don't carry these fees, right? And
Got it.
so it makes it very different. So when you go through this and this white paper and talking about, the actual facts, we also had it compared in what was the effect of the changes in the IRS code compared to all three: 401k, IRS, and IULs. And again, it's stating the differences in the three accounts. And then we talked about the benefits of those three different accounts. And again, sentences here, they kind of look benign, but they're impactful. So here's another one, number two: the investment limit. So as you can see here, it says an IUL, there is no legal limit to the amount you can invest in an IUL policy. No legal limit to the premiums, but it must be within the boundaries set by IRS code 7702. And
Mm-hmm.
again, 401k on IRS says there is an annual contribution limit for both of those accounts. Here's
Mm-hmm.
another important fact is number 4 down here, the longevity. So as you can see, it says an IUL is a permanent life insurance policy. It lasts an entire lifetime as long as premiums are paid. right? And again, comparing it to the 401k and IRA, says the accounts, both of those do not offer a life insurance component, and the value can be depleted. Withdrawals can exceed the withdrawals or the growth if the money is taken out of it. So in other words, it's subject to the market, where
Mm-hmm.
the IRA or the IUL is not subject to the market. So getting to answer your question, again, you can see the risk of all three, and then of course the comparison for all three. But getting here to your question, which is what is different about us, is our solution actually has these components that you see in it. So accelerated debt payment. So it efficiently shows people how to pay off the debt. And so they can pay off a 30-year mortgage in 5 to 7 years. But what's really important is that this technology that we offer that pays down debt integrates with an IUL. So it uses an IUL, and because it is using the IUL enhances the actual characteristics of the
Mm-hmm.
technology. The technology enhances the characteristics of the IUL. And then when you're looking at the IUL, which is used again for banking purposes,
Mm-hmm.
again, it's similar to what people are thinking. And there are lots of concepts out there about banking like a bank, or banking yourself, or infinite banking. But what we do, it turns those kind of concepts on their head, because in this case, the person is not borrowing against the cash value of the life insurance policy. They're actually borrowing against their own money, their liabilities that they put into the IUL itself. So in other words, they're using
Got
the
it.
IUL, following what the technology tells them to do, overfunding the IUL with their debt, and then borrowing against that debt. So the
So,
four, so
so,
please,
so, so, so I'm trying to understand. So, if you take in a mortgage, let's use mortgage as an
sure,
example.
okay,
So, how could somebody pay in the 5, 7 years, right? Normal mortgages like a 20, 30, whatever the years term
that's
is,
right.
25 years standard, right?
Yes,
So somebody takes some money against, take a mortgages, let's say ABC Bank, right?
yeah.
So how does that work with yours? Like, are you taking money against that mortgage? Is that what you're saying that, or how does that work?
Yes. So how it works is like this. Great question. So the technology is actually taking advantage of the principle of the debt. So in other words, it's directing a person or a family to use their discretionary income, so the money that they're not using, to aim it or put it toward the principal of that mortgage. When you pay the principal of a debt or a mortgage, you actually eliminate the interest that is associated with those principles, right? So since Dodd-Frank, everyone is able to use this
Mm-hmm.
principle and pay toward the principal of their mortgage debt, therefore eliminating the interest. So if you, depending on how much discretionary income you have, you can maybe eliminate, 25 years of your mortgage, right? Just depending on how much discretionary income you have. But you're aiming at the principal of that mortgage, therefore eliminating the interest.
So are
So
you paying more towards that principal all the
that's right.
time, or
That's right. You're
so?
paying more toward the principal. And so what the technology does is it monitors your cash flow. It's watching how you pay your bills, when you pay them, how much your bills are, and it's looking in your cash flow for the money you're not using. And it takes that money and directs it towards paying the principal of the debt. Right. So
Got
it's
it.
efficient in a way that if people try to do this on their own, what happens is they either end up sending too much money to the debt, and months later they wish they had some of that money back, or they end up paying too little and end up paying an extra 10 or 12 or even 15 years of interest. With this solution, that doesn't happen, because it is monitoring your cash flow. It's looking for every dime that you're not using for something else, and it will use it toward the principal of the debt. So it's very efficient in that way.
I got it.
Okay.
So no matter where you're spending money, as long as you get an income, so wherever you're spending money, so you're going through this piece of technology is going to manage your cash flow, but it's going to control the cash flow as well. So you're not wasting money here and there. Then it's going to defer whatever the money you can find. It's going to put it towards that principle of that.
Exactly. So it's monitoring, and actually, what's really good about the technology itself is that it makes people smarter about their money. In fact, it shows them the repercussions of every financial decision that they make. And in fact, if they're in commission, or if they make more money, it recalculates. If they make less money, It recalculates. Even if they have an unexpected expense, it just recalculates. So no matter what happens, it creates a path from where they are to zero debt as fast as mathematically possible.
I see. So whatever the behavior is, wherever people spending money is going to just change the trajectory of it when the mortgage is going to be paid off. Not control them any shape or form that you can't do this, you can't do that, but it's
Exactly.
going to change. It's going to recalibrate and change that projection of that. It's not, you're not going to pay in 7 years. If you keep doing this, it's going to pay on a 9 year or 10 years, whatever the path is.
Exactly. So it is. So when we first start off with the technology, which is what we use as a catalyst, is we take that person's cash flow. We take, how much they're paying for debt, what their debts are, what their expenses are. We itemize those expenses. We reconcile their debt, and we put that information into the technology. So we have a set amount. The technology understands what their budget is, and it tells them how much money they have left in discretionary income. However, it does not tell them not to spend money or not to do this. It just shows them the truth about everything they're doing, and it based on paying off the debt as fast as possible. So again, it is flexible. So it just goes with the flow. If they have something that happens, the system understands that. If they have to spend more money, in a month, then they have less money left over in their budget. The system just recalculates and understands that, and then it will take the money that it has left over. So if they go over a budget, then it has
Mhm.
less money. If they go under budget, it has more money.
Wow. And how about this? How do you guys calibrate? It looks like there's inflation is very high. The cost of everything is going so high. Does that changes anything in your side because the costs are changing, constantly in the product and services out
Yeah,
there?
yeah, and that's another great question. So, and I've been doing this, for a number of years, and I was involved in this when interest rates were low, right? And people were doing a lot of refinancing at the time, right? Because they were finding, that interest rates being low, it's a great time to refinance. And what the system would do is it really would help them, even if they're thinking about doing a refi, because they could put the information that they're thinking, whatever they're planning on doing in the future, can put that information into the technology. The technology will tell them exactly how they will come out. So when I first put their information in, it will tell them what date they is planning they're going to have their debt paid off. It tells them how long it's going to take them to pay it off. It tells them how much interest they're going to save. Right. And so it deviates, like you said, to anything that happens in the future. So now with inflation, again, it's been adjusted, but it so what's great about this solution is that because inflation, think about this, if you have the technology and it is eliminating 75% of interest, so when you have a situation like we have now, when inflation is higher or interest rates are higher, it's going to eliminate more of the interest, right? So if someone has this technology and they go out now and buy a house, and they might not have as much competition because the person who doesn't have this kind of technology is going to be reluctant to go out and buy a
Mhm.
house and pay the higher interest rate. But if you have the technology, the bank can give you an interest rate of 7%, and then you come back and you put it into your technology, and you're going to reduce that interest rate from 7% to maybe 2% or less, right? Because the
Mhm.
technology is going to concentrate on paying the principal of that debt.
Got it. Got it. Good. Interesting.
Yeah,
So how do people take advantage of this? So you saying this doesn't only apply to mortgage payment, you this apply to the life insurance, it
that's right.
applies to all those programs as well.
Any kind of interest bearing debt. So it doesn't matter if it's secured debt or unsecured debt, right? It doesn't matter. Not like if you're doing, a settlement or consolidation. In most cases, they're only dealing with unsecured debt because if it was secured by something, then the creditor would just repossess that that debt or whatever it is that they're buying. In this case, they're not consolidating or sliding the debt in any way. It's a systematic or a strategic payoff. Okay? And
Mhm.
so where the life insurance comes in is that if they're using the money and they're moving into a savings account and then taking that money out of the savings account, using the savings account as an offset account, and then paying toward the principal of that debt, they're taking their money out of the savings account and sending it to the principal of the debt. With the life insurance policy, they're able to put that money into the life insurance policy as if it's a savings account and then borrow that money out. What's really different
Mhm.
about the life insurance that we're using is if you find that people online are saying normally bad things about IULs or 401, IULs, talking about what they can do and why it would be less of a great retirement vehicle. And in most cases, we are overcoming those different um, um, the different things that they're talking about. So first of all, they might be talking about the caps. When you get a normal IUL policy, it normally comes with the cap if you're getting it from a normal life insurance agent, which means that it might be capped at 9 points. It might be capped at 12 points. So if the S&P 500, which is again tied to an index, goes up 45 points, you'd be capped at 9 points or 12 points. In this case, the policies that we use, they have no caps. And we're having the client invest in what we call a volatility index. So we can buy multiple options on it. So it has no caps. Second thing that most people say about IULs when they're talking about them and comparing them to other kind of retirement vehicles is a surrender charge. And so in normal cases, when you get a life insurance policy, whether it's an IUL or a whole life policy, you can't borrow from the policy until you have met the surrender charge. So it might be 10, 11, 12 years before you can start borrowing money from the policy. So in that case, he's not going to help you pay off a debt that you have right now. You have to wait 10 years. The policies that we offer, and like I said in the beginning, are more like the bank-owned life insurance, so BOLI policies. So we're giving people an opportunity to borrow from the policy. It's a liquid policy immediately. So in other words, they can put money, their discretionary income, into the policy and then borrow that money out right away and send it to the principal of their debt, paying down the debt.
Got it. You can stop the share run while we're talking.
Sure.
So does that mean, if I'm understanding correctly, that is there certain companies that people have to take mortgages from, or as you mentioned, you guys offer also life insurance as well. So does that mean if I have a life insurance with a different company, I have to transfer that to your company, or mortgages as well to your recommended people as well? So how does that work?
Great question. So the mortgages, no. Right, they can stay with the same company that they have the mortgage with. We're just going to allow them to use a technology. That technology is going to give them instructions of paying toward the principal of the debt. So, a mortgage company, of course, they're not going to tell people that they can pay the mortgage early and eliminate interest because they want to get that interest, right? If it takes them a long time to do it. And what amortization really and truthfully, no matter what the interest rate is, the mortgage company makes money on that mortgage for the first 21 years. First 21 years, you're paying most of the interest on that mortgage. You don't really get halfway to your principal until you're in year 21. In this case, because of Dodd-Frank, the changes in the IRS code, people can pay down their mortgage no matter who the mortgage company is. And you'll see that some mortgage companies will put calculators that will tell people, hey, you can pay toward the principal and therefore eliminate interest. But if you call a mortgage company and tell them that you want to pay down your mortgage early, they will tell you things like make double payments or pay more toward the mortgage itself. And they'll take that money and apply it to the interest. Right. In this case, they're strategically telling the mortgage company that this money is going toward the principal of that mortgage, therefore eliminating that mortgage.
Got it.
So life insurance, yes. If you go to a normal life insurance agent, you're not going to get the same kind of life insurance that we're offering. So we're offering the entire solution from the technology to life insurance policy, and together you're actually banking on yourself. You're banking yourself. So using life insurance that we offer, again, you're changing your tactics because life insurance has no caps, it has no surrender charges. So using the life insurance policy that we offer, they're able to pay down their debt faster. And now they've overfunded their life insurance policy with their actual mortgage debt. And now they're borrowing against their own debt, and they're earning interest on themselves rather than the bank earning the interest on them. So we have this kind of saying that you're either banking like a bank or you're banking for the bank.
Got it. So, and this applies to any business line of credit or business loans as well.
Any kind, anything that can be, that they finance anything that the client is financed. So we've helped people with you know the loans that were the PPP loans, and all those kind of loans, the idle loans that came or out for businesses, and then businesses were paying back. It's what's really funny is, think about this. The way this solution works is really a solution that can be used, for just about any kind of debt. So, right now is a very big about the student loan debts, right? A lot of people are talking about them. If you think about things politically, right, we have the students, or the people who owe on the loans, and then you have the Democrats, and in most cases, they do not want to pay the loans back, right? And then you have, on the other hand, you have the Republicans and the lenders, and they want you to pay back the loan along, of course, with all the interest. Our solution kind of falls in the middle. It's not political, right? It's kind of in between. So a person who has student loan debt can pay that debt back, eliminate most of the interest. So, and they're paying that loan off early, and now that student loan turns into income for them for the rest of their lives. Right?
I see.
Yeah.
Okay.
Yeah.
So they pay. Okay. So they're getting interest back. Okay. Got it.
Yeah.
So what, let's say for somebody taking 100,000 in a loan, right? So let's say the payment is 500 a month. I'm just making a hypothetical number,
Sure.
right? So if I want to pay with your technology or your programs, let's say I want to pay off in 5-7 years, how many times I have to multiply my payments? That is going to be, do you have any idea, like how many times I have to add more to the payments for me to do that? Because that may not be affordable for a lot of people, I guess, right?
No, well, it's not that way. So, when you're thinking about it the way, you're still thinking more like a consumer, right? Rather than thinking like a bank, right? And if I may, I'm gonna share my screen again, if you don't mind, and I'm going to show you. Let me first of all, let me bring up this here and make sure that I have it open. Okay, so what you're going to see here is a spreadsheet that we use, and I'm going to again share this so you can kind of see it. So so what you see here is a spreadsheet, and it's called an arbitrage. This is a spreadsheet that banks use to calculate the money they make on loans. So when you're looking at it, a bank, I'm gonna grab my pen here so you can just kind of see what I'm talking about. But a bank would borrow money, let's say from the federal government. Okay. And then they loan that money to a consumer. They mark it up and loan it to them. So the bank then makes a spread on that money. Okay. So here, what you see here is as if a family is buying a home, and the home is $400,000. Or I'm taking it back. The cost of the home is $350,000. Okay. But they're paying interest on that home, and let's say they're going to pay $250,000 in interest on that home. Right. So they would then, that's $600,000, right? $350,000 for the home, $250,000 for the interest. But then they use the technology that technology eliminates $200,000 of the $250,000 they have in interest. Right. So instead of paying $600,000 for the home, they're only going to pay $400,000 for that home. Okay. So what this number here is this number, the number they're going to pay for the house, divided by the years they're going to pay. So let's say they're going to have the house paid off in 4 years. Let's say they're 55 years old. If they were dealing with the bank, they have a 30-year mortgage. 55 years old, in 30 years, they'll be 85 years old. Okay. Except, again, now they're paid off in 8 years. So they're only 63 years old. Okay. So what you see over here, again, are the numbers, right? And again, this is pretty conservative, because, when I'm illustrating this, I never really go to higher numbers. So I tried to be very conservative with this. So as you can see here, this is the profit. So this same person now becomes this bank. Here, they're going to put the money, the discretionary income, into the life insurance policy over 8 years. Okay. So what you see here is that right? So at the end of this 8-year period, they're putting the money in. Life insurance company, when I'm showing this, is allowing them to borrow that money out. Let's say borrow 95% of the money that they put in as they put it in. So at the end of the 8-year period, their loan back to the life insurance company is $431,000. However, in this case, because they're not using a savings account or a HELOC, they're using the life insurance policy, that money stays in the life insurance policy. Okay? So that means they are earning the spread, right? They're earning the spread, that 3.25% on their money in the life insurance policy. So at the end of the same period of 8 years, their loan is $431, but their cash value has grown to $505,000. So they earned the spread while they're paying off their house. So they earned $73,000 from the life insurance policy. Now here they are, they're 8 years into it. They paid off the house. It's done. They have no more debt. Okay. But now they have the equity in the home, but they also have in liquid cash $73,000. Okay. Now, CDC, right? So CDC says people are not retiring at 65 anymore. They're retiring at 70 years old. So they're working extra, right? So what you see here in this yellow line, so this orange line is their debt. They're paid off of their debt. This yellow line is when they retire. So as you can see here, the loan has grown now at 70 years old to $679,000. But the cash value, which is growing faster than the loan, is now $965,000. So again, they're earning the spread on their own debt, on their loans. So they have now $285,000 in liquid cash from paying their home off early.
Right. So how much were they were paying monthly on this, Ron? If you just use the same example, what was the payment look like? What did they pay?
So it would be the same. So what they would be paying here is the technology. So that's a great question. What I'm showing here is that they have only $600 in discretionary income. So they're paying their normal payments. They're paying off their debt, and they're taking $600 that they have left over. And that's where they're starting in the beginning, right? But as they pay down the debt, this discretionary income is going to grow, right? Because they have less debt to pay. And now the $600 continues to grow. And so, as you can see here, again, I'm basing it on a very conservative number, which is the $600 in discretionary income. So they're paying their debt payments, whatever they are, to pay off the house in 4 years or 8 years, right? And now their discretionary income is going into the life insurance policy.
I see. So they're paying the house for the house, and they're paying $600 on top of that for the life insurance.
That's right. Not well, yeah, for the life insurance, yes. So the life insurance, and it's very funny, because of what you're asking, and there is a cost of life insurance. However, as you can see here, they're actually earning money on the life insurance policy. So the premium or the cost of life insurance really doesn't matter in this case. Right? And following, if you remember that sentence that I read to you about, you can make a life insurance, right? Doesn't matter what how much the premium is or the value of life insurance. So all I'm concentrating on when I create this life insurance policy is what they need per year, which is this number right here, to pay off their debt in time in the 8 years. So if they average this amount over the 8 years, they can pay off the house.
See, yep.
Right. And this is really just the beginning. So let me show you that it can go further. So what you see down here is now they've turned 85. Again, the CDC says if you live to be 65 years old, in most cases, a couple, one of them is going to live to be 85 years old. Second person in the married couple is going to live to be 92 years old. So as you can see here, grab my pen again. They've actually, by 85 years old, they've earned $1.8 million from the life insurance policy.
Interesting.
So now think about where they are. They've saved $200,000 in interest. They say 22 years of paying the bank. They are now debt-free at 63 years old. They own the house, so they have the equity in the home. Their life insurance policy that they overfunded with the debt is earning interest. And now at 85 years old, not only have they paid off the debt and they saved all the money and then the interest, but they have an additional $1.8 million.
Interesting. Got it. Okay.
Yeah.
So let's talk about your business, Ron. How's where's your revenue come from? Is there technology that you guys sell? Is it an app that you guys sell, or is it from a consulting? Where do you guys come from?
So great. So it's funny because our income comes from the technology, right? So we are representing and working with the developers, and they're continually updating the technology. So we get paid, from the technology, but it's very inexpensive, right? Especially compared to what it does. I've had people, that have $80 in discretionary income, and I've saved them $360 in interest, right? So the technology itself really is a solution that they can afford, and we can finance it so they can pay for it, monthly, and again wipe out a lot of their interest. As far as the life insurance, it's funny, we really take the hit on that because we're offering the same kind of life insurance policy that Bank of America would be using, or a BOLI policy. We're allowing them to take all the money out of the policy as they pay on their debt. So we don't get paid in advance like normal life insurance agent would get. Once they get a policy, we get paid in advance. We get our money spread over 6 years, right? So what we're doing is we're taking the hit, right, for helping the person build generational wealth from their debt. In other words, so yes, right. So we get less money, yes, but we get more clients. So the more clients that are getting involved in this allows us to keep the volume up. In other words, so we make our money through volume rather than an individual amount of money in advance for life insurance.
Got it. So people can. So how do they access the technology? Do they download an app on their phone, or is it a website account they start?
It is a SaaS program, right? Okay. So it's a program that they can go to on their computer, they can go to on their phone, and they can access it that way. And so it makes, like I said, it makes them smarter about the money because it's really like a bookkeeping solution, but it's much smarter than that because it gives them ideas of what to do. It tells them what to do. It tells them how they can eliminate their interest.
But there's a lot of consulting and guidance built into that, right? So walk people through here. Let's say,
Yeah. So it's funny, because we started with the conversation about financial literacy, and I would say that this app or this solution is instant financial literacy. And what's really funny about it, when I've learned about it, is that it changes the way people look at their debt, right? People have been doing and paying their debt a certain way all of their lives. They've been, paying it. And in many cases, they come to us and they're in trouble, right? They have, bills that are piled up. This technology makes them smarter. It's like instant financial literacy. So it makes them smarter about their cash flow, makes them smarter about what they're doing. They think twice about buying things. They can see what it would cost if they did something, and it tells them the truth about it rather than, through rose-colored glasses, right? And exactly, yeah.
Something magical about when you show people that the consequences or result of their decisions is that then, very often people change their decisions when they're trying to make some decisions on an ongoing basis, right?
That's right.
When you show them, hey, if this decision is going to impact you this way,
that's right.
A lot of things changes. People's perspective changes.
That's right. Yes. And what's really funny also is the software has a true cost button. So in other words, somebody can be spending some money, maybe they had a flat tire or something that happened, kind of off the cuff, and they can put that in there that they're going to be paying for that. And the app will tell them how much that is really costing them. Even though they're writing a check for a certain amount, it tells them this is what the real cost of that is. So they can see what it costs them. So even on things that they want to do in the future, like they want to take a vacation or they want to buy another car, right? They can see the real cost of those things before they do it. And that's what is really good about the app, and again, it keeps track of everything. Right?
You guys
So
get into keeping a track of credit cards and all that, the cards as well, or
all
is
of
there a
those
different?
things. That's all of those things.
Okay.
And the app, it also gives them advice on things. Like for instance, people don't realize that you can get a credit card, right? And it doesn't matter what the interest rate is on the credit card, but you can use that credit card to pay your monthly expenses, right? Those things are you're paying with cash anyway. So if you put those things on a credit card, that is giving you money cash back at the end of the month, and then you pay those things off just as if you would do if you were paying cash for them. You would eliminate the interest on that credit card. However, the bank will still throw you the cash back, right? So they're almost getting paid for using a credit card on certain things, right?
Hmm.
And so we showed them how to do those things. And by the way, we have an app for this solution. So you can go online. You can, if you have an iPhone or you have an Android, you can go and download the bank like a bank app, and it will show you how this all works as well.
Got it. So it's called like a bank app. Is that
Bank,
what it is?
bank like a bank. That's what it's called. Bank
Like a
like a
bank.
bank app.
Okay.
Yeah.
Okay.
Yeah.
Very interesting.
Yes.
So let's talk about your journey. How did you get involved in this, and what you've been journeying, and what got you interested in getting into the app or technology business?
So I've been in technology all my life. So before this, I was more in kind of security and drones and those kind of things. But I did a lot of research, during those days. And so when I got involved in this, I got involved because I myself was in debt. Right, I went through a divorce in 2006. I had a home that I had bought, before the divorce, and when we went through the divorce, I ended up paying my ex-wife half of the equity in the home. So I ended up underwater in that first
Hmm.
home. I had bought a rental property and I lost the equity in that home. And so and a friend of mine introduced me to this technology, and I saw how it could help me and put me in a better track to pay off that house, which I was underwater on, and also to make equity on the second home. So I still use it now, kind of more offensively, right? So I'm using the app. I used it originally to pay off my debt, and by the way, I went between um, 2010 and 2017, I paid off over $1.2 million using this app. Okay. And now I'm using it differently because now I'm buying properties, and I'm able to pay those properties off early. I'm leveraging this technology so that I can get to the equity in my homes much faster. Yeah, so that's how I
See.
kind of get started in this. Is I'm just like everyone else, you know. I had problems with debt and credit cards and cars, and this app helped me fix my problems.
Got it. So this app is built by as somebody in a US, like who's this built by,
Yes.
and you become a reseller of the app, or how
Yeah,
does
so
that work?
yes, so I'm a partner with the app, so I'm an executive director there. So
Okay.
and I work closely with the developers and tell them what they need to do, what they need to add, and they're continually updating the app. Yes, it's a United States app. It's really the developers out of Utah, California, out of Utah,
Nice, nice.
Salt Lake City, Utah, in fact.
Got it.
Yeah.
Yeah, it makes life much easier when you have a direct access to developers. You can influence what changes need to be applied, and then they can changes as you see that experience, or you see your customers are dealing with what kind of challenges they're dealing with, and you have access to developers. You can get them to change whatever issue they need to tackle on a customer
Yeah.
side, right?
Yeah, absolutely. And before the life insurance came, or this change in the IRS code came along, I was offering life insurance. So I would have people, they would purchase the app, they would pay off their debt, and then I would go back and offer them life insurance. But after the codes changed in the IRS codes changed in 2020 CARES Act, and the reason they did change is this, because people were dying of COVID in 2020. Right, when a
Mm-hmm.
million people died, right, and so life insurance companies, in most cases, or they're investing money, but through the bond market, because they were paying death benefits for these million people that died during COVID. They didn't have a lot of money left over to put in the bond market, right? So the
Interesting.
bond market was hurting. So in order to help the bond market, Congress changed the IRS codes, and so we noticed the loophole there, and so we saw that because of these changes in the IRS code, we can use a life insurance policy as an offset account, substitute the savings account using a life insurance policy, which allowed our clients to not only pay off their debt, like they were doing using a savings account, but now to make money
Mhm.
by borrowing that money from a life insurance policy and pay that debt down.
Very interesting. Very interesting.
Right.
So where has been some of the bigger challenges, Ron? Definitely, the people not aware of it, that's going to be the biggest challenge. Where other challenges been that for into this to the, such a great technology. I'm just wondering why people are not using it, and what's been your obstacles?
Well, people are starting to use it much, much more because they're starting to understand and realize the differences. And we try to point those differences out. So I would say that one of the biggest challenges definitely is getting the word out. And in the beginning, and again, remember, this part of the solution is not that old. And after 2020, right? So 2021 is when we started, March or April of that year. And in the beginning, we were pretty naive ourselves. We knew that this was a good solution, right? And we understood how it worked. But of course, we've learned more and more over this last couple of years ourselves. But in the beginning, we were thinking that we would advertise this, right? We would go out and we would place ads and we would talk about what we're doing and we would tell everyone that we're doing. But then we decided that we didn't want to do that because we don't want to make the banks angry. Right?
Yeah.
We don't want the banks to be our enemies. We also need the banks. We still need the banks to loan people money. And so one of the biggest challenges is how to talk about this, how to get it out, how to organically getting it out without advertising and making the banks. By the way, just so you know how I know this is because we're a minority company. And so I joined the National Minority Development Council, and so every year they have a national conference, and so they look for companies to write information that could help maybe close the wealth gap or help businesses so they can get contracts with larger companies. So a couple years ago, I wrote a thesis, and so I went to speak at the event, but my my speech was about how people can overcome what the banks are doing, right? How they can, not pay interest. And this event happened to be sponsored by the banks, of course.
Oh.
So, so of course, they didn't allow me to speak at this event because, hey, I would be speaking on the stage talking about the guys who were the sponsors of this event. And so it made me also realize, though, that if they don't want the banks to be angry, we don't want the banks to be angry either, right? We don't want to tell the banks what we're doing, and it was better for us to kind of, do this organically. So what we're doing is we're bringing in more agents, and definitely looking for agents if you're interested in that, and helping people, right? Because the key for us in this solution is that we are helping clients. Okay, we're making money as agents, of course, and we have technology and so on and so forth. But for the person, for the end users, for the families that we're helping, is changing their lives, and that's what's really big about this.
Yeah. We're gonna put this on a YouTube podcast. I'm sure no bank's watching my podcast, so not to worry about it. There's no banks gonna listen to my podcast, so you don't have to worry about any of that stuff.
Okay, all right.
Good stuff. Hey, listen,
Yeah.
I learned so much from you. I think it's a great technology. People should, learn more about it and go take a look at and definitely connect with you and get some more details. We never gonna be able to understand or learn everything from social media or from a website. But maybe discussion with you, connect with you and learn a little bit more about you and see how this technology can help them to make them, get them debt free and much sooner than they would do without it.
It's funny because we advertise on Facebook, right? So
Mhm.
clients come to us and because they want to pay off their mortgage debt, and and we not only help them pay off their debt, but we show them how to make money off of paying their debt. And so, people are really skeptical when they come to us because they've been taken advantage of. They've seen lots of ads on Facebook and they think we were just a normal. It's funny, I've had people come onto the calls, and usually I'm booked all day long, and they come into the calls and they're saying, well, this is already different because it's not a recording. You're not speaking with some kind of accent or something like that, and so they're pretty skeptical when they come there. But again, we on our website, which is financialliteracygroup financialliteracy.group is our website. We put lots of third-party information there. So lots of places, lots of information for people to go and research it and to do due diligence and understand what we're doing. And I think those things are really important. So we don't really try to sell that much on the website. We really that site is there to support what we do. And by the way, we do have not only the financial literacy group website that I just talked about, but we have a Betterment site. So we're also using this as an employee benefit, right? So employers and employees as well.
Yeah, no, definitely we're going to put our discussion on all the social media and with your contact information as well, and spread that awareness a little bit, right? Educate people. Maybe people will connect and hopefully they will reach out to you for discussion and see where who knows where discussion can take them, right? So but we'll definitely include what is the best way for people to connect with you, Ron. What is the go-to method to have a chat with you?
Yeah, definitely. So they can they can book me. So of course they will find me on Facebook, but if they go to the website, there's plenty of places for them to book an appointment. So I would say booking appointments is one of the big things, but they can also call, and the phone number that we have is area code 323-419-1600. You can reach me there. My extension is 1005, but you can reach any of the agents there. And we consider ourselves, financial literacy group professional educators. So we educate people on what they can do for their debt. And again, we're an alternative. We're totally different from everything else that's out there. So we're not advocating mutual funds and 401ks and those kind of things. We're kind of an alternative to that. So
yeah, and well, definitely, I learned so much from our discussion. I'm sure business leaders were watching. If you look into deal with your business loans or any line of credit, if you want to pay that faster, connect with you. You'll learn so much from your discussion. So definitely, I will list your phone number and email, all the website below this video as well, and encourage all my colleague business leaders to pick up a phone and talk to you and figure out how you can help them.
Great, please. I would love that.
Okay. Thank you so much for your time, Ron.
Thank you so much.
Okay.
All right.
Bye.